Hi, my name is Paul and welcome to my monthly portfolio review series. As of this moment, I've invested $100 per month into Canadian securities for 26 months straight, and I've done so with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their TFSA. But despite these circumstances, I think that by following a disciplined plan of investing $100 every month, our Canadian protagonist will be able to achieve retirement and live happily off of their investments in financial freedom. In this month's episode, we have earnings reports from all three of the portfolio's major holdings. We have guidance updates, shocking price moves, and a huge dividend raise that I'll be covering alongside the important information to come out of these earnings reports. Plus, I'll be showing you how my portfolio is holding up against the benchmark ETFs and how the recent dividend hikes have impacted the portfolio's expected dividend income. Needless to say, this episode is going to be a bit on the longer side, so if you're here just to get my take on a specific company or topic, then I'd recommend using the video chapters to hop over to whichever part you're interested in. For everyone else, let's hop right into the 1-month performance of the individual holdings. Starting us off, we have our worst performer of the bunch, MTY Food Group, who reported some mixed earnings, which did get a pretty negative reaction from investors as the share price declined 10.9% immediately upon the release of these earnings. So let's take a look at what spooked people and if this downward move was justified. Starting off with the negatives, Canadian revenues declined across the board, with their restaurants' weaker performances being chalked up to customers pulling back slightly on discretionary spending, which impacted MTY's higher price point banners, which tend to operate mostly in Canada. But the management did note that customers are still showing up, however, they just seem to be spending less on average. As for the food processing and distribution segment, it continued to falter because of lower sales, supposedly due to grocery stores pushing their own brands. Compounding on this already bad news, operating expenses were up substantially for the Canadian franchising segment and moderately for the corporate segment. Now, before we get carried away, it should be noted that most of MTY's business is conducted within the US and that the brand mix within the US is mostly quick-serve restaurants with lower price points. And, believe it or not, the operating differences when split by geography are like night and day. Where Canadian revenues slumped, US revenues were up double-digit percentage points, aside from the food processing and distribution segment, which is still suffering from last quarter's termination of a licensing contract that's been temporarily suspending product sales. As for the US operating expenses, these actually saw a double-digit percentage point decline on the franchising side, and the corporate side saw its OPEX grow 6% slower than the revenues, both of which are great to see. Summarizing this, the margins contracted on the Canadian side, but expanded in America. And while it would be more ideal to see expansion and growth on both sides of the border, I don't think that these specific results should have been enough to cause the sell-off. That said, earnings per share did come in quite low relative to recent quarters, which may have panicked some investors. But if we look at last year's fourth quarter, it becomes apparent that low Q4 EPS is just a standard part of MTY's business cycle. This is because of the Barbecue Holdings acquisition, which added tons of corporate stores, and corporate stores, unlike franchise locations, have property and expected future cash flow values that are carried on MTY's balance sheet. And over time, if the market value or projected inflows change, then this needs to be accounted for. When you do that, this creates a line item that directly impacts the net income under the generally accepted accounting principles. In MTY's case, they generally calculate most of these changes annually during the fourth quarter, and recently these have taken on the form of asset write-downs or impairments. Now, it's important to be aware that this does not actually affect how much money the company made or lost despite its effect on net income, which is why I tend to prefer to look at free cash flow instead of earnings when trying to get an idea of how well the business actually performed. So, all things considered, this potentially scary EPS figure was actually pretty normal and isn't something to be concerned with on its own. Digging further into what could have been the cause of this sell-off, the management once again failed to achieve positive net store openings with 97 store closures versus only 94 openings. This means that the quarter had a net decline of 3 locations, which definitely is not a good thing, since the management did say that they would be getting a hold of these closures and turning things positive in past quarters. But even still, these numbers are pretty close to break even and probably shouldn't have led to a major decline in share price, even when considering the other bits of negativity in the quarter. And honestly, that was about all there was for the bad stuff. So now let's take a look at the positives. And to start off, typically Q4 is a slow quarter for most of MTY's larger categories. As you can see here, the fourth quarter is usually a soft quarter for both Cold Stone Creamery and Wetzel's Pretzels, while it's usually strongest for Papa Murphy's. But apparently, Papa Murphy's has a significant portion of its customer base that utilizes EBT, which is essentially a government aid to low-income residents for the purpose of purchasing food. And within the last few quarters, the US federal government, as well as a few state governments, have reduced the amount of benefits that can be received for food post-COVID. Apparently, this had a significant enough impact on Papa Murphy's that it was mentioned more than a couple of times on the conference call. But why am I mentioning it in the positive section? Well, this means that even though there was weak performance out of the one banner that generally carries the quarter, free cash flows per share still hit an all-time high of $1.81. So, with Wetzel's projected to have its strongest quarter in the coming Q1 on top of slightly less strong numbers out of Papa Murphy's, we could be looking at another very strong quarter for free cash flow. Now, the free cash flow growth in part was due to the company's capital expenditures coming back down to near normal levels, since the company has completed their restaurant builds. And it would go even lower, but the management has decided to invest between $1 to $2 million per quarter for the next 2 years to integrate a new enterprise resource management system, which should create greater efficiencies over the long run. As for the future store openings, the CEO seems to have backed off from attempting to give an exact timeline on hitting net positivity, as there are too many variables on the closure side to make accurate predictions, which probably should have been considered before providing guidance in the first place. But this is a minor issue of bad optics. The good thing is that on the more predictable openings side, the future pipeline was quoted as having never been healthier, and there's a growing backlog of stores set up to begin operations upon the completion of the permit and inspection processes. Taking a look at how the company allocated its capital, first, MTY paid off over $27 million in debt, which reduced the total obligations by $33.7 million. Then, there was the 12% dividend hike that I covered in last month's video. And lastly, I was shocked to find out that the management decided to do a surprise share repurchase of over 80,000 shares at an average price point of $51.58, which is really good considering how cheap the company is trading on a price to free cash flow basis. And in even better news, despite all of this heavy spending, the company has maintained its strong cash position, which is actually up from the previous quarter, which speaks to the strength of the company's ability to generate cash. Now, I won't try and make it out that this was some exceptional quarter. It was definitely disappointing that the company failed to achieve positive store openings, the food processing and distribution segment is looking shaky, and the Canadian side of operations is absolutely miserable at the moment. But MTY is a stock that was already trading at a reasonably attractive price prior to earnings, and there wasn't really anything new or scary to come out about the company that made me believe that it deserved to drop below $50, which it did for a while. But it did crawl back up to end the month at $50.50, about 14% below where I purchased shares at the start of February. So that was pretty brutal, and I even got shortchanged on the dividend payout. On the brighter side of things, let's head over to the Morguard North American Residential REIT, who also reported earnings this month. And the stock price didn't really move on earnings, but it did slowly trade upwards over the rest of the month. Jumping into the report, Morguard, in its predictable, stable ways, improved its tenant occupancy in both the US and Canada. And while the average monthly rent per unit ticked very slightly lower in the US from last quarter, this is expected to be a temporary backstep, with management still projecting slow and steady rent growth throughout the rest of the year. But the period of spiking rent prices does seem to finally be settling down. At least in America. In Canada, on the other hand, most of the REIT's properties are located in Ontario, and the Ontario government has been implementing rent control to artificially lower prices for tenants. But the lack of new inventory alongside strong immigration has seen rents on apartment units being leased out to new tenants skyrocket 23% higher than what the previous tenants were paying. So, with the 2.5% rent increase limit on existing tenants in place as a temporary solution, it's ensuring that rents will continue to raise for a long time to come. So, on the Canadian side, we're likely to continue seeing strong occupancy and consistent rent growth for the foreseeable future. Moving over to the REIT's profitability, funds from operations continued to increase, even when factoring out the anomalous one-time increases that can't be expected in the future. Diluted AFFO came in at 41 cents per share, up from 33 cents in Q4 of last year, and up from the 37 cents per share earned last quarter. Now, this is usually expected when we see the occupancy and rents both heading upwards on the whole. But while higher AFFO is great to see, it doesn't tell the full story, and in MRG's case, it's still nowhere near enough to cover the costs. See, funds from operations do not take into account interest expense, let alone capital allocation projects like capital expenditures, dividends, and share buybacks. Unfortunately, interest rates have continued to rise, and they are costing the REIT $20 million per quarter, which eats up the majority of the $25 million in diluted FFO. Including the capital expenditures, dividends, and repurchases, these costs went well beyond what the REIT earned, and so the cash pile has dwindled considerably and now rests under $18 million. Thankfully, having done our due diligence, this was not a surprise, and as dire as the numbers might look, it's important to realize that the capital expenditures in Q4 are always higher than usual in order to complete renovation projects ahead of the upcoming busy leasing season. In conjunction with that, the management stated that the capital expenditures will go back down to their usual low levels during Q1 and Q2, which means that the current cash pile should hold up until Q3, where the management hinted at refinancing as well as tapping into its revolver, which alone is capable of providing the REIT with an additional $102 million of liquidity. So, contrary to the prediction I made last quarter, it sounds like the REIT is looking to utilize more debt to finance its projects rather than selling a property. In fact, there was even some talk on the conference call of potentially acquiring a new property at some point in the back half of 2024, though management is still prioritizing the repurchase of shares throughout the year. Now, unfortunately, we did not get any updates on the number of shares repurchased last month, so we'll probably just have to wait until next quarter to find out whether or not the 2023 NCIB was fully maxed out. But we do know that the REIT has been diligent in its repurchases, as you can see from this graph showing the consistent reduction of the total shares outstanding. Lastly, we have to take a look at the property values, which were slightly down on the quarter, but it's essentially even, so nothing really to worry about there. Plus, because of the buybacks, the tangible book value per share actually stayed even at $49.10, despite the minor dip in the property's values. So, all in all, another decent quarter from the Morguard North American Residential REIT, which helped to push the shares up 3.14% from $15.27 to $15.75. And that gain does not include the February dividend that the portfolio received. Last up, we had our best performer, Goeasy, who also reported earnings this month. Yeah, it was a busy one, but luckily Goeasy's quarter was pretty straightforward. This company is just a world beater. New loan originations for the quarter came in at over $700 million. the total consumer loans receivable have increased by $210 million from last quarter, with the percentage of secured loans up an additional 500 basis points. In addition to that, there were once again record new quarterly loan applications of over 530,000. They added nearly 400 new merchants to their point of sale financing network, and the average weighted interest rate on consumer loans has come down to 30.25%, all of which is excellent. The company is growing while reducing costs for their customers, and it's still incredibly profitable. This quarter, the adjusted diluted EPS came in at $4.01 per share, which is up over 30% from this point last year, and up nearly 6% from the prior quarter. That's insanely fast compounding, and it's coming on the back of consistently low net charge-off rates, which, when paired with the greater number of secured loans and increasing average credit score of its borrowers, requires Goeasy to put less and less capital aside for loss provisions, and that's money that can be allocated towards growth initiatives and rewarding shareholders, like with the newly announced 22% dividend hike. And despite how strong a 22% raise is, because Goeasy grows its earnings so quickly, the payout ratio is still very low, making up only 33% of the company's trailing income. So there's plenty of room for continued dividend growth in the coming years. That said, not everything is perfect. The company is still in the phase of utilizing debt in order to expand operations, and this is exceptionally risky considering that the money Goeasy is borrowing is being relent to people with lower credit scores. So Goeasy's customers are probably going to be a little bit more negatively impacted if the economy takes a turn, which leaves open the possibility for the company's fast growth to start heading in the opposite direction just as quickly, if not faster. And with a big pile of debt hanging overhead and less money coming in to pay it off, things could get a bit hairy, especially in a rising interest rate environment. But as was reiterated this quarter, the company is producing significant cash flows such that the company will gradually and continually become less and less reliant on debt to fund the income growth, and over time, they will delever. Now, none of this is new or necessarily even bad news. It's just something to be aware of. That said, everything else is just more good news. This quarter, Goeasy updated their 3-year guidance, and the numbers once again were revised to be even better than before. The previous high-end projection for gross consumer loans receivable is now the low-end projection. Meanwhile, projected net charge-offs have decreased, and margins are set to expand 2 whole percentage points higher, despite lower average projected APYs for customers and a stable return on equity of over 21%. And keep in mind that Goeasy has either achieved or exceeded every single one of their guidance forecasts for the last decade. So these improved figures are likely to be conservative according to the CEO. But we're not done yet. There's still more good news. On the conference call, the CEO announced that the company is in the process of developing secured and unsecured revolving credit card products to serve the needs of Goeasy's growing customer base who have very few reasonable options when the major prime lenders turn them down. And the management believes that the company can provide a better product than is currently available that will also surpass the 20% return on equity hurdle that the company seeks to achieve with its offerings. Now, the CEO received a really good analyst question on the conference call looking to gain clarity on what changed regarding the company's stance on the creation of a credit card, since in the past, Goeasy was always focused on providing loans because they provide easy-to-understand, fixed, predictable payment patterns for the customers who tend to struggle with credit. And it's true. Several years back, the CEO was opposed to creating a credit card product for its borrowers. But thankfully, nothing has changed with his original stance, which, to paraphrase him, is that most subprime borrowers should not have access to revolving credit products because they're not healthy for them. However, as Goeasy has grown, they've attracted a wider range of customers, many of which are near-prime borrowers with credit ratings above 600 who would benefit from having access to an unsecured card option. Meanwhile, Goeasy is working on developing a product that will rectify some of the issues with modern cards by increasing the required minimum payments such that it enforces some repayment of the principal. That way, interest can't grow out of control on relatively low starting balances. This should have the added effect of discouraging wasteful spending and helping to build credit. And I think it's amazing to see that the company is working towards ethically tackling one of the biggest financial problems facing North America. Plus, none of the future growth from this new project and development has been factored into the prior forecasts. That said, the cards won't be hitting the market in a large way until the back half of 2025, since the company generally likes to take its time analyzing and tinkering with their products before they release it in order to assure they've developed a quality project that will also bring in good income. So yeah, I don't really have much to criticize from Goeasy this quarter, and honestly, I'm surprised that the stock price didn't go up even more on earnings. But we did see nearly a 10% increase from the start of the month, with the share price going from roughly $152 per share up to about $166.50 as of the market's close on Thursday, February the 29th. Unfortunately, with MTY making up about 20% of the portfolio and Goeasy making up only about 10%, the needle didn't really move too much from last month, and the portfolio is still in the red, but only by about $58 or 2.17%. And the book value of $2,688 does include the reinvested dividends. So the portfolio is technically up a little over $30 on the $2,600 of capital that I personally put into the portfolio. Taking a look at our monthly performance versus the benchmark ETFs, February was a month where the portfolio fell a little further behind, with the S&P 500 being the big winner, putting up a 3.14% one-month gain, followed closely behind by the Global Value ETF, which grew by nearly 3%. Then we had the Canadian Large Cap and Canadian All Cap ETFs with 2.51% and 1.91% growth respectively. And bringing up the rear was my portfolio with a loss of 1.9% if we don't include the dividends. But that's just the 1 month performance of the capital that was invested last month, which did not include any of the Goeasy shares, which did help bring my portfolio to a very slight gain net of contributed capital over the previous month, as you can see here from the green line on this chart. That said, all of the ETFs did outperform my portfolio, as did the monthly goal line with the red stars, which represents a 12% annualized rate of return. And right now, the portfolio would need to increase by 11.5% to get back on track with the goal. On the other side of the spectrum, we have the dark red line, which represents the S&P 500. And as you can tell, it's been absolutely crushing it and is a further 11% above the goal line. But I don't expect that these results will continue forever, and I do still believe that I will in time be able to reach the goal line and surpass the S&P 500. It might just take a little while, but that goal is secondary to achieving financial freedom for our hypothetical Canadian. And in order to do that, I'm going to need to invest this month's $100 and the dividends that were earned in February, which are already waiting in the Wealthsimple account. And this month, I'm going to be putting a little bit more money than usual into MTY Food Group because it's ridiculously discounted at this point, trading at a price to free cash flow of about 7. To put that into perspective, even if the company were to see no growth at all in the coming years, it would still produce more than a 14% annual return on today's investment. So the market is of the belief that this company will decline in the coming years, and I just don't see that happening. Sure, there are still some weaker banners that are holding the company back, but the larger banners are all strong growers, and they're starting to become more and more concentrated as the weaker banners close locations. Plus, the company still has the famous Dave's franchise project in the works, which should also present the opportunity for some added growth in the future. So at this point, I believe the downside is very limited for MTY, and the upside could be very strong, especially considering the implementation of the new ERP system, which should create additional efficiencies and potentially even improve margins and sales. As for the rest of this month's money, it's going into MRG shares, which are still only around $16 on tangible net asset value that amounts to over $49 per share. Now, because Goeasy's operations have been so strong relative to its share price appreciation, which, mind you, has also been quite good, I do think it's trading at an attractive valuation again, and I would be willing to purchase more shares at the current levels if it weren't for everything else being so much cheaper. And this feels a bit weird to say considering I wasn't willing to purchase more shares at lower dollar amounts in previous months. But with the consistent earnings growth and increasingly conservative loan mix, I feel that at the current price, I would be getting a reasonable compensation for the risk. So if the shares stay around the same price in the coming months, without there being any new negatives regarding the business that come to light, then I may well end up getting my feet wet. But it should be noted that there are a lot of factors that lead me to make a decision to buy, so everything kind of needs to line up for this to happen. And to be honest, I think Goeasy is one that I might look back on with a hint of regret, considering how close I was to buying more shares back when it was trading in the 110s. But that might just be hindsight talking. In the long run, I know it's a better strategy to be a bit more risk adverse and deal with a little regret over money not made than it is to be more risky and suffer the consequences in times where things don't play out as you'd envisioned. So, in my opinion, if you aren't sure, then you probably shouldn't risk it. After all, it's not such a big deal if it takes you a little bit longer to cross the finish line. It's making it there that counts, and trust me, big mistakes can prevent you from getting there. But missed opportunities here and there aren't really going to set you back anything. To paraphrase the words of Warren Buffett, you as an investor have the opportunity to wait and wait and wait for a pitch that's right in your sweet spot before you swing. The market isn't like baseball. No one's going to call you out for not swinging at the pitches that barely make it into the strike zone. So with that, I'm going to hop into the Wealthsimple account and buy the stocks that I feel confident will provide me with a good return. Okay, I'm here inside the Wealthsimple account. It is currently Friday, the 1st of March, and I have $109.57 to invest here. So let's start with Morguard. This month, I think I'm only going to buy 4 shares. Then we're going to go ahead and put the rest of the money, the $45.69, into a fractional buy of MTY Food Group. Okay, I just received email confirmation that I've successfully purchased 4 shares of the Morguard North American Residential REIT for $15.97 each, and 0.9029 shares of MTY Food Group at a cost basis of $50.60 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, as of the market's close on Friday, March the 1st, the portfolio has 121 shares of the Morguard North American Residential REIT worth roughly $1,924, about 11 shares of MTY Food Group worth slightly over $554, and the same 1.62 shares of Goeasy, which are now worth about $275. Taking a look at the dividend tracking chart, in February, the portfolio earned a new monthly record of $9.57, with $6.91 coming from Morguard's monthly distribution and $2.66 coming from MTY's quarterly dividend. Now, you might have noticed that last month's center-right cell, which shows the projected dividend income, doesn't match the actual dividend income that came in that month, shown in the cell to its immediate left. This was because something weird happened to MTY's dividend. Now, I did get the newly raised dividend rate, as was expected. However, the shares that I purchased last month before the ex-dividend date did not yield me any earnings. So, why did this happen? Well, I don't know for certain, but my best guess is that it takes a few days for trades to clear on the back end of Wealthsimple. So, while the order was filled and the shares showed up that they were in my account on the 3rd, I probably didn't show up as an owner in MTY's records until the trade actually cleared a few days later, just missing the ex-dividend date. Now, this is a pretty unique occurrence that, to the best of my knowledge, has never happened to me before, though I've never really tracked my projected dividends as diligently as I have for this portfolio in this series. So maybe this is something that happens on other brokerages as well, but I was kind of confused trying to figure this one out for a little bit, and this seems to be the only explanation that really makes sense. Luckily, my projection was only off by 15 cents, so it's hardly going to make a difference in the grand scheme of things. And believe it or not, after just 2 months of collecting dividends in 2024, we're already ahead of the total dividends earned within the entirety of the first full year of investing $100 per month. And so far, this puts us at just over 13.5% of the $130 goal for fiscal 2024. Now, as for the $9.57 earned last month, that's enough to buy this large bottle of laundry detergent, which means a lot of clean clothes in the future. Though our hypothetical Canadian will still have to spend some time patrolling parking lots for loose change in order to afford a trip to the laundromat. However, I'd still consider this a successful month, since in reality, we're going to be reinvesting these dividends to expedite the process of getting to financial freedom. Unfortunately, we're still quite a ways away from that, since next month the projected dividend income is only supposed to be $7.22, all of which will be coming from the Morguard North American Residential Real Estate Investment Trust's monthly payout. Taking a look at the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $109.41, which is another 5% increase from what was expected last month, thanks largely to Goeasy's 22% dividend hike. This means that Goeasy alone is paying the portfolio a 5% dividend on the average price that I paid for shares. Meanwhile, the full portfolio's yield on contributed capital now sits at 4.05%. And that concludes this month's episode. So thanks for watching, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I'm not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.